Wave of consolidation and acquisitions are happening among some of Africa's biggest banks, from Kenya all the way through to Nigeria and beyond. These consolidations are happening just as vulnerabilities are increasing the challenge of credit risks for the continent's banking sector. Kabeya is Vice President and Senior Analyst in charge of Financial Institutions Group at Moody's Investor Service, attending the Africa CEO Forum in Abidjan, and joins us live now. Good afternoon to you. Thank you so much for joining us. How are banks across sub-Saharan Africa impacted right now, I guess, by the pandemic and the war in Ukraine?
Good afternoon. Thank you for having me. So we think that the implications of the pandemic on banks in the African continent are gradually starting to reduce. And we think that in 2022, the conflict, the military conflict in Eastern Europe will have more implications for banks in Africa than the pandemic. Just to give you a little bit more detail on those 2 points, when it comes to the COVID impacts, the implications was, as you know, varied depending on which region you were looking at on the African continent. Countries where the health impact of the pandemic was relatively severe, and or the restriction put in place by the government to protect the population were severe, are the countries where the economic contraction was more important, and hence the prime loan formation and the implications on the profitability of the banks was more significant. If I take, for example, the example of the South African banks, they did significantly increase their provisioning in 2020 in anticipation of an increase in problem loans we did materialize in 2020. As I was saying earlier, this impact is starting to wane. So in 2021, we saw problem loan gradually starting to come down in South Africa and in other banking systems. Just to touch briefly on the implications of the Russia-Ukraine military conflicts, when we think about the implications for banking systems globally, there's really 3 transmission channels. The first is the high commodity prices, implications of higher food and energy prices. The second is the financial market volatility and the tighter funding conditions. And the third one is security challenges, operational challenges. For African banks, the most important are the first 2. So the implications that higher commodity prices have, as well as the implications that tighter funding conditions have. And the third point, which is around security challenges, cyber risk attack, risk of potentially breaching sanctions, exposure to the military conflict are much lower when it comes to African banks than some other banks globally.
Thanks for that. Well, what's your assessment of African banks' credit risk generally in relation to the global vulnerabilities you've mentioned?
Sure. So if I was to drill down a little bit more on the global vulnerability that results from the military conflict in Eastern Europe, first of all, the higher commodity prices, so higher food and energy prices, do weigh and reduce the disposable income and the purchasing power of borrowers, particularly on the retail side of the loan book, and that has implications for the repayment capacity, and we expect that will have negative implications on the ability of retail clients to repay the banks, and that may affect the quality of the loan books. If you think about the tighter funding conditions globally, and as you know, the Federal Reserve has been raising interest rates and is likely to continue to do so later this year and over the coming months. That has implications for funding conditions of banks on the continent. So that also weighs on their profit and loss. And maybe just an additional point is the monetary policy stance of the various central banks on the continent to fight inflation means also that borrowing costs are going up for borrowers, both on the retail side and on the commercial side. The last point I'll make on this topic is that some countries are actually benefiting from these higher commodity prices. So markets like, say, South Africa or Angola or the DRCs, these are countries that are commodity exporters and that actually benefit from these higher commodity prices.
All right, and this, we've talked about a wave of acquisitions and consolidations by banks from East to West Africa. What's your view at Moody's on these deals?
Sure. So, as you know, the credit implications of an acquisition really depend on the specificities of a given deal, right? So it depends on the targets, the strategic fits between the targets and the acquirer. It depends on the cultural fit, but also on the price that you pay. But broadly speaking, and by and large, if you look at these M&A transactions in East Africa as well as in West Africa, as you mentioned, we see them as credit positive because they strengthen the institutions that acquire these targets. They provide them with growing opportunities to grow their business and their lending. These are often entities that have a significant market share in their home base and now are looking to grow into market with lower banking penetration. So by and large, those M&A transactions are credit positive for the banks.
All right, well, that's good. So in that case, do you also have a positive outlook, I guess, when you consider the biggest risks to the balance sheets of sub-Saharan banks and how these risks can be mitigated?
So the biggest risk on the balance sheet of sub-Saharan African banks is their exposure to the sovereigns. As you know, on the African continent, banks tend to have a relatively contained or small portion of their balance sheet which is in the form of loans. There's a fairly sizable portion of the balance sheet which is in form of exposure to the sovereign typically through purchases of sovereign debts. That's the case in banking systems like Kenya or bank system like Ghana, for example, where depending on which bank you look at, the exposure to the sovereign can be around 40 or 50% of the balance sheet. So, in sub-Saharan Africa, that significant exposure to the sovereign, means that the creditworthiness of the banks is linked to the creditworthiness of the sovereign, and if a sovereign was to weaken, that will have implication as well in weakening the credit profile of the bank. There are, however, some mitigants in terms of profitability and capitalization, because banks on the continent tends to be quite profitable and also tend to have sound capitalization levels. So those two buffers provide some mitigants to be to be able to absorb the potential risk from the exposure to the sovereigns.
Great stuff. Do you expect any deals to be announced at the CEO forum in Abidjan, or is this just going to be a general discussion and outlook on the region?
I don't have any particular expectation in terms of deals to be announced. I would just say that there's a lot of entities that are active across the continent, and over the last year or so, we've seen quite a few M&A deals on the continent.
Great stuff. Kabeya, VP at Moody's, thank you so much for joining us. We really appreciate you talking to us about the outlook on sub-Saharan African banks across the continent. Thank you so much.